Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing podcast. I am your host, Real Estate Cody, and man, what a great way to kick in the turn of a new year and having a great podcast guest on the show. But before we get to that, Brian, Happy New Year, buddy.
Happy New Year, Cody. Nice to see you in 2022. We made it. We
Uh,
survived.
we made it and had a very good 2021. So looking forward to the prospect of 2022.
Oh, yeah. It's going to be a big year.
It is, man. It is. So this is exciting too. We just hit our 100th episode milestone the week prior to this episode release. So really, really excited to have our guest on today, episode 101. Man, it's been a fun ride. What do you think?
Absolutely. It's been great. I'm looking forward to what we can do with the podcast and continuing to add value to people in 2022 and beyond.
Yeah, man. Great ideas for the show this year. We're going to take it to the next level. So looking forward to that. But without further ado, tell us who we are talking to today.
Today, we are speaking with Chris Freeman of Hightech Freedom. Over a 25 plus year career in high-tech sales and leadership, Chris actively invested in multifamily real estate with a buy and hold strategy focused in the Pacific Northwest. In an effort to share his experience with other high-tech sales professionals, he founded Hightech Freedom. Hightech Freedom is helping high-tech sales professionals create passive income in real estate while crushing their sales quota. Chris, welcome to the show.
Yeah, thank you, Brian. Thank you, Cody. I'm excited to be part of the next 100.
That's right.
Well, we're excited to have you here, man. And what a great way to start off that next 100 than, having you on and such. So looking forward to learning about you. Tell us a little bit more about your background and how you ended up, getting into commercial real estate.
Yeah, so I've always been in tech sales or high tech sales, and so when I started early in my career, I landed a job with a company that was paying pretty good. I was making some really good money during that 99 era, so pre-dot-com bubble. And at the time, I was always pretty focused on saving, earning, and I was already mapping out my 30-year plan on, all right, if I put this much into my 401k and my IRA and keep doing that every year, this is where it'll be, doing the cost of money calculation. And so I had it kind of mapped out, and I didn't know any other option besides that. Well, when I got into tech sales, I started putting all my money into tech companies in the market. And I was also working for a company that in your 401k, they would give you matching like most companies do. But if you took it in company stock, they would almost double it. And so I was like, oh, why would I not do that? The company stock is on a rocket ship. So, it was all good. And, everything was up and to the right. And I was feeling rich and feeling great. And then the, dot-com bubble happened and the market collapsed. And it wasn't like the Great Recession that we went through here more recently where, the market or those companies came rip roaring back. Back then, those tech companies went out of business. They went to zero, and your stock went to zero. And so I lost quite a bit in the market. My 401k was really crushed. And at that time, I had just bought a duplex. So I never went into the single family home space. I started with the duplex, moved into half of it, I guess the equivalent of house hacking at the time. But I didn't really have a direction for my real estate journey. And right about that time, I met my future partner who had already been in the real estate multifamily space for 30 plus years. And I was watching him during the dot-com crash continue to make really, really good income off of his multifamily assets, which, by the way, were all completely paid off. And so it was like nothing had impacted him in any way, whereas he had a number of really wealthy friends or pretty, well-to-do friends, but they were living off of their portfolio. And so they had to start dialing back their dining out. They stopped going on their international travel trips. And, I watched them get kind of nervous. And so right about that time, I was like, you know what? I want what he has. And so I really put my head down and said, all right, my goal is to build up 300 units that are fully paid off. And that'll generate all the income that the family could ever need to give back to charitable things that we're interested in. And then, leave probably a bunch for the next generation. And so that's really how I got started. And I've always had that goal of 300. And I've learned over time there's other ways to generate what I'm looking for than owning the building outright. But that was kind of my initial goal when I started back in really 2000.
I love that start, Chris. And I think, very similar to a lot of other people, it's kind of like you get into a piece of investment real estate. And then from there, it's just a lot of kind of just figuring it out, right? But then you get a taste of it, you get a reality of, hey, this is more security than relying on that, traditional 401k and whatever else comes along with that. And then that's really what kind of fuels you to keep growing your business, because you start to understand that, the traditional model of putting your money in a retirement account and hopes that you're going to be okay by the time of retirement, that to me is your biggest risk, so I mean, kudos to you for learning that early and getting started. So, and looking back too, I mean, talk about timing, right before the .com bubble. And we talk about this all the time with other people like yourself who've been in the industry for a period of time. You've been through several cycles now, you've been through several downturns now, where you see, how difficult it is for the typical W-2 earner to navigate that versus the savvy investor, right?
Mm-hmm. Yeah, I always just felt like the stock market was, it's gambling. And I've been to Vegas a bunch of times on golf trips with friends, but I do not enjoy gambling because I do not enjoy the lack of control of what happens to my money. And I always just felt like the stock market was that. And I don't get me wrong, I still max out my 401k and take advantage of the matching, but that is not my vehicle for retirement. It's just part of my diversification strategy.
Ooh, let's talk about that real quick, because I think that's a huge nugget right there. Because for those who don't know, the 401k was never intended to be a retirement tool, right? The founder himself of the 401k, God, I forget his name, but if you go back and listen to his story about, he accidentally discovered that in the tax code. And then when you discovered it and kind of made it the 401k that it is that we know, it was designed to be really a savings tool for employees that's supported by their employers, right? But then it quickly transitioned for the employers of, hey, I can now, as an employer, I can put the responsibility of a retirement on the employee, and I don't have to pay out pensions. And then what do you see? The last couple of decades, you've seen pensions go away, and now you, the employee, are stuck with the 401k as your retirement tool. But it was never intended to be that. So you just dropped a big nugget, and you're still using it, but you're using it, sounds like, more as a kind of a forced savings account, so to speak.
Well, just, if a company's going to give you matching, I mean, that definitely is juicing some returns. So I'll put into the 401k to take advantage of the matching the company's going to give me. And then everything else I put into different, mostly real estate.
Yeah, that's kind of where I was going with that, man, because I think that's super, super smart. Because if you really map it out, and we're digressing here a little bit, we'll get back to your story, but I mean, it's such a powerful thing for people that really need to be open to right now, is if you map out really how much you would have to contribute to a 401k to be able to sustain or to reach a level of retirement that is equivalent to the lifestyle you're maintaining now. I mean, it's hard to imagine that most people could achieve that, right? You're talking about, putting in excess of 20% of your earned income into a 401k just to be able to hopefully hit, a sustainable retirement that's equivalent to your standard of living now. So that's a huge number.
Yeah. And realistically, Cody, I don't believe most people have done that math. They don't really know how much they need to be putting in to get the returns that they want. They just do it.
Mm-hmm. Yeah. Yeah. So that's why we have the show here, Chris. That's why we try to provide that financial literacy and help people open up to this world of, commercial real estate investing. Obviously we're biased to, but just alternative investments, right? Just being more prudent. And like you said, taking control of your finances. And that's the most important message that we want people to understand, is you have control, i.e. when you invest in real estate, you have so much more control over that versus the exposure you have if you just tuck your money away in a 401k and, wish for good luck. So,
yeah. Can I just follow up on that? So, to that point about getting to retirement and not having the income to support that lifestyle that you've built up over time, that's a big part of why I started my Hightech Freedom brand, and really just sort of catering to the high-tech sales professional. Because what I saw early on, I just remember being up in Bellevue, Washington. So I live in Portland, Oregon. I remember being up in the Bellevue office one time and talking to a rep, and happened to be on an airplane with another rep at that same trip. where they're both, they were up there in years, and let's just say, I don't know, 60. I don't know their age, but I remember looking at them thinking to myself, I know these guys have been incredibly successful. They've made a lot of money in high-tech sales. They've probably fully funded their 401k, and this is early in my career. I'm like, why are they still grinding it out as sales reps? And what I realized was, and one of them told me was, well, hey, over time, my wife and I have built up a lifestyle that we enjoy. And if we retire, our 401k is not enough to sustain that lifestyle. And they hadn't done anything else to build up any additional income streams. And so that always stuck in the back of my mind as I was doing this. I didn't want to be that. I wanted to be able to make the switch and, have no impact to our lifestyle. Now, I don't want to creep up that lifestyle to match the spending that we're making. I think everybody needs to find that sweet spot and stick with it. And sometimes I think some tech salespeople struggle with that. The more you make, the more you spend, and it becomes kind of perpetuates down the road to become a bigger challenge come retirement. So that's something I've been very, very passionate about with my fellow tech salespeople.
It's a great message, Chris, and it's a message that resonates very well with me, because I think we all here agree with that same principle. I mean, if you think about life, you have one life to live. What fun is it to be able to work your tail off for 40, 50 years, get to retirement age now it's 65, but by the time that we get there, it could be 70, 75, who knows? And then you can only retire on a third of your income and have to live on a third of your lifestyle that you're used to now all these years. Like, that's no fun, man. It's
no fun.
Why not enjoy life now? Right. So that's awesome. I appreciate you sharing that story. And I think, like I said, it's a message very well resonated across our audience for sure. So what do you think, Brian?
Absolutely. I mean, it's important for people to understand the power of diversifying, right? There's nothing wrong with taking advantage of the power of the stock market or the power of an IRA or the power of a 401k. But you have to also realize that stuff is very volatile. And I'm with Chris. I don't like to invest in things I can't control. It's not my preferred vehicle of choice. You could wake up one day and literally it's all gone. It's just like snap of a finger, right? So with real estate, which is why, we're biased here, but real estate moves very slow. Even when things are changing, whether it's going up or it's going down, you kind of see it coming. And as long as you buy right and you're doing things the right, following those real estate fundamentals, things might not be as great as they were when you're at your peak, but you're probably not burning the whole building down and falling apart either. Things tend to sort of smooth themselves out, which we've seen with multifamily, which is why it's been so successful in such a hot real estate asset class for the past several years. People have seen what happened during the Great Recession. People see or now what happened during COVID. And they're like, whoa, this is a very attractive, it's not super sexy, but it's a very stable, safe, to use that term, investment vehicle.
Yeah, absolutely agree, man. Absolutely agree. Well, Chris, let's kind of get back to your story here, because I think, what a great way to kick off the show and kind of lead us into, more of your background here. But you mentioned, you're still contributing to your 401k, which means you actually are still a W-2 employee, right? In addition to your Hightech Freedom, business. So talk to us a little bit more. What's the decision making behind maintaining your W-2 still while building your real estate business?
Yeah, well, if I'm completely transparent, I have creeped up my lifestyle a little bit, and so I like the benefit of both, right? It's it definitely has created quite a bit of opportunity for me and my family. The piece though that I really enjoy and why I still in doing what I'm doing is I love the technology space. Now, I'm not an engineer. I don't geek out on the technology. I just like how I've always been kind of in the sales realm, and I like that how technology is always changing the environment. And what you were good at 5 years ago isn't necessarily going to translate. The sales skills translate, but the problems that you're solving, the problems that you have to try to identify with your clients, you have to continue to sharpen the skills. So just like you and your audience in the real estate space, they're listening to the podcast because they want to sharpen their skill. And for me, technology sales, it's similar because it's always evolving, and it's an opportunity. If you stay on top of your game, it's an opportunity to do really well and continue to fuel other things that you want to do. So for me, it's helped me accelerate some bigger things that I want to do in the real estate space and in the charitable space.
Cody, I love that story because, we hear the stories all the time, right, of people quitting their W-2s, and there's absolutely nothing wrong with that. Everybody has different goals. But we always tell that to potential passive investors too, right? Like there's nothing wrong with enjoying your W-2, especially if you like what you do, you feel like you're well compensated, you like the lifestyle it provides. But then finding real estate and using it as a vehicle to sort of throw some gasoline on the fire, so to speak, and preserve a lot of that wealth. I really like what you're doing there, Chris.
And one thing that I've learned that so I've talked to people, and I'm sure you've talked to people as well, that they really want to leave their W-2 and go full time into real estate. And I'm always very cautious of that, because if you're running from something to something, when has that ever worked out in life, right? Whether it's a relationship, a marriage, or a business. If you can't make what you're doing work, and you don't have that success mindset already, how are you going to translate that, or how are you going to start off on a healthy footing into your real estate journey? So I just would caution people to make sure that they're doing it for the right reason. Maybe they have so much opportunity, they're running to it, great. But if you're running from something, you probably need to do a little bit of a mindset. And the other piece that I would, to people out there that are looking to do the real estate and maintain their W-2, I think number one, if you're going to do that, you have to make your W-2 a priority. Hey, they're paying you, they're giving you a paycheck, and it's the right thing to do. Is you need to show up and deliver every single day, so that there's never a doubt that you're committed. And I've been doing it long enough now to where I can be more open about my real estate journey, because I have a track record and I've been producing, and I've built up enough credibility over time. But you owe it to your company if they're going to give you a paycheck.
Chris, you bring up a lot of great points here, a lot of powerful points too, especially the point of, the mindset shift in, like you said, don't run away from something to chase something else. I think that's a really powerful statement there. And, I think another point to mention here too, and it goes against the grain, so to speak, from a lot of big industry influencers in the space that say, oh, if you're going to be committed, you need to be committed full time and blah, blah, blah. But what you don't understand is this is a business. You're operating a small business, and that small business needs, revenue and income. And if you are transitioning from a W-2, and let's say for your example, where, I hope I make a safe assumption here, where you're probably earning a pretty, sizable income or decent income. Mm-hmm. If you transition out of that and try to take an income from your business, if you're not producing enough income from your business already, you're going to stifle the growth of that business, right? And so it's really important for people to understand when you're transitioning the dependency on an earned income to your business, it could really slow your growth. And that's something for people to be really cognizant of, because that could lead you to fail very early on if you're not prepared to make that transition.
That's such a great point. Yeah.
Yeah.
It's we were talking about this. So I have a couple partners that we each have our own logo, but I've got two other partners that we pretty much align on most deals. And one thing that we've talked about with other partners is you have to keep an eye out for those operators that they're so desperate to make that income they have to go find that next deal. And for me, with my investors, I don't. I could go all year, and I'd rather just make sure that I'm taking care of my investors than being desperate for the next deal. Because I do, and I think maybe it was Terry Painter that you had on. One of your previous guests was talking about how we're going to be going into the world of the operator versus the deal finder over the next few years, and I really think that is so true and critical to understand. You don't want to be so desperate just to go get the acquisition fee or just to get the next deal that you start tweaking your numbers to make it work to get the deal done.
Chris, I can't tell you how excited I am. If people saw me on the screen here, I did a little fist bump when you brought this topic up, because it's such a huge, huge point that people really need to respect right now in the industry. Is you're absolutely right. When we talk about being a syndicator, and we talk about alignment of interest between us as general partners and our limited partners, there always has to be that alignment of interest through the entire life cycle of the deal, right? And that means everybody is engaged. Everybody's taking ownership of this one building and deal, and we're making sure that it's executing to its highest performance, right? Well, if I, as a general partner, like you said, if I have to go get another acquisition fee because I'm dependent on that income, my alignment of interest is deviating because all I'm worried about is the next transaction, and next transaction, next transaction. So as a passive investor, that's going to probably make me a little uneasy, because I want you focused on my deal. I want you focused on my interests, So man, that's such a great point, Brian. I'm excited.
No, that's a great highlight. I think it's important. It doesn't mean that if you're full time, you're going to be doing bad deals, but it's just something to be conscious of. We've heard that before from people. They're like, well, you're not full time. I'm like, well, yeah, that means I don't need the money. So I'm not transacting to transact. Right. And I think that's a great just sort of counter argument, so to speak, and why I think, you can still invest in people with operators that still have those W-2s because, they're not transacting to transact. They're actually looking for really high quality deals. It's a great point.
Yeah. It becomes quality over quantity. Right.
Correct.
And I think that's huge, man. Oh, good stuff, Chris, man. Great nugget. Well, now let's talk though. It's not easy being a general partner, and it's not easy being a syndicator. It's a lot of work. We all know that, right? I mean, everything from finding the deal to negotiating the deal to getting in a contract. And then the real work starts when it comes to operating the deal. So talk to us about how you're handling that as a W-2 employee, and all of the load that comes with owning and operating a small business.
Yeah. So my journey has developed over time. So for the first, I don't know, 15, 18 years, it was just really my own assets with one partner here locally. I live in Portland, Oregon, so all my assets were here. So 110 doors, and trying to self-manage all of that for the majority of that time. So great division of labor with a partner makes all the difference. And so my partner loved to handle the maintenance, loved to handle kind of going to Home Depot and figuring out, what do we want to do with this new floor plan or whatever. And I didn't. I handled all the business. I handled all the leasing. I handled tenant relations because I'm a sales guy. And so I'm comfortable working with people, and he was not. And so that worked out well up to a point. When you get to a point of scale, you start getting so ingrained in the business, you can't step back and look at how the business is doing or even grow. And so that's where we found ourselves at. And so we made the decision to move all of that to property management. And man, I wish I would have done that sooner because my partner is, he's a whole different generation, and he comes from this mindset of, man, you got to scrimp your pennies. You can't spend anything. And what I learned was, wow, a good property manager can get in there and make you money, right? Operate it better. And so that has been just wonderful because it allowed me to step back and figure out, all right, I want to diversify outside of Oregon. How do I scale? Well, I can't go to other markets by myself. So then I need to go find partners. And then also, if I'm going to do that, I might as well do it at scale, because what I also learned going from a 4 unit to an 8 unit to a 26 unit is like, wow, they're no different. It's just more doors, more zeros. And so, I figured out, let's just go do bigger deals, 100 plus units. And so the partnership that I formed, or that I'm working with my two primary partners, we have a great division of labor. I'm more focused on the investor relations. We all will raise capital, but I'm focused on the marketing piece. When we have a deal, helping out with the email templates, the communication plan. My one partner, he's got the deal flow coming in, so the two of us won't even see the deal until he's taken it through his own funnel, and then it'll hit us, and we'll go through and poke holes in it and make sure everything looks good. And then my third partner, she's flipped a ton of houses, and she has multifamily assets. And so she really takes more point on the asset management. So we'll all join the asset management calls, but I'm really going to look to her to be the point person on that. And so that's, we all kind of, everybody needs to do everything, but currently that's the division of labor that we've been able to find that seems to be working really well right now. And then we just, my deal finder partner, he just hired a person to really front end the underwriting process to free up some of his cycles, because he was getting so sucked into just spreadsheets that he couldn't go maintain the relationships that were needed to continue to drive the deal flow.
Sounds familiar, Cody.
I was about to ask you the same thing, Ryan. It just sounds so familiar, but very, very similar framework here at Blue Oak as you guys have over there at Hightech Freedom, Chris. So it's really cool. But I want to go back to your point you mentioned about when you first started kind of self-managing, kind of doing everything on your own. I think this is it's a process that most new real estate investors have to go through when they, especially as they get into multifamily. And this is a kudos, and this is why we encourage people not to start in single family, because when you come from a single family background, you're kind of ingrained with that mentality. It's a one-man show. You're doing everything on your own. It's not a team sport by any means in general, not for everybody, but multifamily, of course, you have to rely on a team, right? Like you mentioned, you have to rely on partners, that division of labor, which is critical to your growth. So it's a big mindset shift. So people that can skip all that together and come in and realize that, hey, I need multiple players to help me get to where I need to go. It is a pivotal switch, and something everybody needs to realize in multifamily. We still hear it from time to time, right, Brian? Where a couple of people are like, "Oh, it's that I'm a mentality. I'm just still going to do it my own." And it's like, well, you're going to be very, very frustrated here shortly if you're not already. So,
yeah, that's the beautiful thing about multifamily. The pie is big enough to share with everybody, and you realize the more people you add to your team, the pie just gets bigger and bigger, and everybody gets to win, which is also a great feeling, sharing with others.
Yep, absolutely. Well, cool, Chris. So you got a great partners. It sounds like you got a great system now. You're scaling. You've been in the business for some time. Looking back over the past couple of decades, talk to us a little bit about some of the maybe mistakes that you kind of made along the way, or some things that you stumbled across that, like you said, oh man, if you looked back, if you could have did it differently, what would you have done?
Yeah. So early on, the attention to detail, I just can't stress how important that is. And I look back, I remember we had this fourplex that we bought. So this is when I scaled up from a duplex to a fourplex. So this is my first deal with my partner. So we bought this fourplex and it was great. Really neat brick building, and everything was going fine. And this is back before we had, a SaaS-based accounting system. Everything was in ledgers and binders and paper. And so he would pay the bills, and he liked handling the money, and I was fine with that. But the property tax statement, so in Oregon, property taxes are locked. They can't go up more than 3% in a year, which is kind of neat.
Ooh, how do we get that in Texas?
Well, you don't want what goes along with that, though. So I would take what you have. But they are locked in at 3%. But this particular lot had two separate tax lots with the building that sort of crossed over both tax lots, and all of the tax assessment was on one lot. And the other lot didn't really have any assessment. I mean, a few $100s. Well, at some point they went in and they re-swizzled it and evened it out, which made sense since the building covered both lots. But when they did that, they then jacked up the price on both lots. And so I missed it because he was paying the bills. And then the next year came around and I was like, why am I looking at this bill? It seems like it jumped up, because look at the tax statement and you can see how much it went up. And I was looking back at the previous one, and so I was like, this doesn't seem right. And so we went back to go contest it, and went to the volunteer board at the county here within Portland. And they basically said, yeah, we agree with you. But you know what? You missed the window. If you would have come back last year, you probably would have been able to attest this and have it revert back to where it was. So as a result, property taxes went up like $2,000, $2,500, and on a fourplex, that's a lot of income. And so, the good thing is we ended up selling it and did great, rolled that into a 15-unit building. But just that attention to detail and having a system in place, and maybe doing that before you start to scale, it only gets harder the bigger that you get. And so figuring it out when you're small can save you a lot of time and hassle as you grow.
That's a really good point there, Chris. And I mean, when you talk about attention to detail, you're talking about dollars in this business, right? I mean, every detail has some type of cost associated with it. And like you mentioned, I mean, a missed detail or a missed mistake can be very costly. And I think going back to your point earlier about, kind of you realize the power of going bigger. That's the advantage of going bigger is, with bigger properties, with more net operating income, you can typically absorb a little bit more of those unknowns.
Yep.
But you're absolutely right. You need to learn the skill set of being able to digest, every aspect of your deal and make sure that you're paying attention to those details, because it can be critically important. And like I said, it can be very costly if you miss something like that. And we've seen or heard examples from other, people in the space that, things like that happen, and it's unfortunate, and it happens to everybody. I mean, there's a lot of things that you just absolutely can't predict or can't see, but it's like you said, it's better to gain that skill set up front, especially working with those smaller properties, so you can apply that to your business as skills. What do you think, Brian?
Yeah, absolutely. Attention to detail can make or break a deal sometimes. You miss one line wrong on an underwriting spreadsheet, or you make one wrong assumption, and your very attractive deal is now not very attractive. So we definitely encourage active investors to have that attention to detail, as well as passive investors as well too, right? Ask a lot of good questions to see if your operator knows their stuff, and it really can kind of highlight if the deal is going to head in the right direction or not.
Mm-hmm. Yeah.
The other thing I'd say, that I might do different is that what we're doing now. Early in my real estate career, I was very heads down, just go do it. And you don't know what you don't know. And now that I've over the years have expanded my mind and just networked with more people and tried to surround myself with people that are kicking butt in this space, I'm always amazed by the ideas and the insights that I hear. And it's to the point about a partnership. If you're out by yourself, you can't self-assess, or you can't challenge yourself. You may think you can, but you can't throw out ideas and then feed off those ideas when you're all by yourself. And so surrounding yourself with other people, I think that could have accelerated my real estate journey. And maybe there would have been some deals or some assets that I decided not to go into because of what I know now. It's all lessons learned, and it's all worked out great, but I definitely would have started engaging with people and networking with people, even as a passive investor. The more educated you are just from talking to people, the better decisions you're going to make.
Yeah, I think we definitely agree with that, Chris, by any stretch of the means. But I think too, there, like you said, there's something to be said about learning those lessons. And I think the most important part is getting started, right? You're not going to have everything perfect out the gate. You're not going to have everything figured out. There's a lot of learning on the fly. And I mean, look, you could be the best attentive person to detail. You can be the best operator out the gate. I mean, whatever your skill set may be, you could be the best of the best. But there's, like I said, you're going to come across things in this business that you're not going to be prepared for. I mean, we always reference COVID. I mean, look at COVID. Nobody had experienced a global pandemic like COVID prior to this on that scale. So it challenged a lot of people, and it forced a lot of people to be creative and kind of learn on the fly. And that's part of it. So I think that the point I'm trying to make is, look, number one, don't try to be perfect getting started. Just number one, get started. Don't be afraid to fail, and don't be afraid to learn lessons along the way. And but you said the most important thing is learn, take those lessons and apply them to your business and never stop growing. No matter how experienced you get, never stop growing.
Yeah, I just wrote down this quote. I was reading a book, and it's a Mark Twain quote that says, 20 years from now, you will be more disappointed by the things you didn't do than the ones you did do. So, it supports, just get started and go.
Ooh, I like that one. We're gonna have to tag that one, Brian.
Too. I like it.
Well, Chris, in speaking to, let's make a little bit of a pivot here. In speaking to your background, number one, I like talking to tech professionals on the podcast here, because we joke all the time, right, Brian, where real estate as an industry has been slow to evolve with technology, right? It's been a very lagging industry sector when it comes to the incorporation of technology. I think we're seeing it more now, and I think it's becoming more of a standard. I don't want to say we're still too early, but it's, a lot of people are still having some hesitancy in adopting technology and stuff. But I think the demographic who's becoming today's renters, they're millennials, right? I mean, most of them are millennials, and that's the expectation. We've all grown up in this world of technology, and like you said, it's ever evolving. And so we expect those efficiencies at our disposal in our homes and things like that. So I always enjoy talking to people with tech backgrounds, because the big question is, how do we see tech evolving in the commercial real estate space? But for you, with your background, I would have to assume or imagine that you, when it comes to engaging with potential passive investors or investing partners, you're probably targeting people that come from a similar background from you, right? Like you said, tech sales professionals or tech professionals in general. Is that a correct assumption?
Yeah, absolutely. I mean, when I look at my LinkedIn network, it's 90% tech people, 10% real estate people. And then out of those 90%, I don't know, maybe 80% of those are tech salespeople. So it's like, why don't I just focus on the market and the people that I can connect with the best, which is what I do.
Awesome. Well, in speaking to those, because I know we have some, several people in our audience that are probably tech professionals very similar to you. We've had a couple of tech professionals on the show before. What would be some things that you would like to convey to that audience why they should consider investing in multifamily real estate, maybe as a passive investor, for example? Like what is it about this that makes it so appealing for you as a tech professional?
Yeah, I think if I take it down one more level to the tech sales professional, or maybe the tech sales engineer, the role is challenging and the expectations are high. They pay you really well, but as a result of paying you really well, the expectations go up. And so I think for those individuals, they're busy and they don't have a lot of time to go out and look at a duplex or try to go buy an asset and try to manage it. And some do, but the reality is sometimes at the end of the day, maybe you've been out traveling, you've been on sales calls, you've been in meetings, you've been working on deals, you get home, you're tired and you want to go play with the kids or go coach a soccer game or go to, little Johnny's Cub Scout meeting. And, the opportunity to invest passively is a way to get your real estate exposure without having, the risk of time that sometimes goes along with being a more active investment. And personally, I've made trade-offs, right? I've given up lots of weekends of golfing with my friends and doing a lot of the fun things that they all were doing because I chose to hunker down every weekend and deal with issues, work on opportunities. So if you're willing to do that, great. But I mean, I think a lot of people have to make that decision that, hey, what's right for me and my family and my kids? And, it's really about that freedom of time that I think a lot of people struggle with nowadays. And that's really what I talk a lot about when I'm talking to people that are considering, passively investing in real estate.
I love that, Cody. He's highlighting, I guess, what you call opportunity costs, right? If you're doing something, you can't be doing something else. So when you're making that decision to either be an active investor and do what Chris is doing and give up a lot of your nights, give up a lot of your weekends, a lot of opportunities that maybe would be leisure time, or you're considering being a passive investor, it's really about that opportunity cost. What are you willing to give up in order to get what you're trying to get? And if you're not willing to pay the price of that opportunity cost, maybe it's better that you lean more on the passive side so you can let the professionals who are willing to put the time take care of you. But if you're like Chris and you want to get your hands dirty and do that, that's totally okay too. But you got to really sit down and look at yourself and go, what am I willing to pay from an opportunity cost standpoint?
Yeah, and I don't come from a tech background, Chris, so I can't speak with 100% confidence with this, but I know a lot of tech professionals that we interact with and engage with, they all seem to love what they do. I mean, I think overall people in the tech industry, they love the tech industry. They love what they do, but it's a very demanding field. That from everybody we speak to, it seems like it's nonstop. It's a kind of a 24/7, 365 kind of gig. Like you said, technology is always evolving, so you always have to be, one step ahead of the game. So I think most people that we engage with, like you mentioned, they love what they do. They don't have any intent to maybe separate from their position as a professional, a tech professional. But they are looking for ways to preserve their wealth. They're looking for ways to, maybe find tax advantage strategies that could help them reduce their tax liabilities. Because, again, don't want to incorrectly assume, but a lot of tech professionals are high income earners. And so there's, like you said, opportunity that comes along with being a passive investor in commercial real estate with guys like you, right?
Mm-hmm. Yeah, and in the tech space, there's quite a few what they call startup companies, and the professionals that go into those startup companies, maybe as an engineer, maybe as a salesperson, maybe as an executive, whatever it might be. That's a little sub-dynamic of the space where you kind of have to be all in, right? Because there's a window. They've raised capital. they are in round one, round two of wherever they're at in their capital injection, and they have to go deliver to that next bogey, whatever that bogey is. Maybe it's a certain number of customers, revenue, getting their product to market. And so everybody needs to be all in, focused on that. And it's a window. There could be a nice payout at the end when you're successful if you have some RSUs or stock options. But that would be a great example of where they just don't have the time to go be thinking about, well, I'm going to go spend time in multifamily real estate. Mm-hmm. But if I can go invest passively, set it, forget it, do my due diligence, and then move on and get back to work.
Yeah, absolutely. I think that's huge. And I think that'll resonate very well with a lot of people. And like you said, I mean, as an active investor, there's a lot of sacrifices that have to be made. I mean, you mentioned sacrificing weekends and things like that. I mean, we live that every day, so we know that. And so for most people, that doesn't suit their interests. Time is valuable. And so, like you said, there's something to be said about just being able to find a good investing partner that you trust, invest with them, invest in an opportunity as a passive investor, and then just know that you have a little bit more security in commercial real estate than you do some of the alternatives, bank and 401ks and stocks and things like that we've discussed. So, but good stuff. Well, Chris, you also provide a platform to educate other people on things like this, investing and things like that. And I think it's targeted towards tech professionals. Tell us a little bit more about your platform.
Yeah, so I have a podcast that actually launches in 2 days. So it's called Hightech Freedom. And the podcast is really focused on tech sales professionals, where I bring on other really highly successful tech sales professionals to talk about how they've crushed it, career advice, lessons learned. It's very similar to what we're talking about today, but more in the tech sales role. And really the theme behind it is you first need to learn from the best in order to earn like the best. And then how do you take those hard-earned commission dollars and redeploy them in a way that'll generate an additional income stream down the road, so you can have that freedom that we're all looking for. So it's probably 80%, sales related, 20% investment related, because in my mind, you have to have the complete package to be successful in life. So Hightech Freedom, it'll be on all platforms January 1st.
Love it, man. That's awesome. We'll make sure that's in the show notes. We'll make sure to promote that for you as well. And listen, I kudos to you for being able to provide that platform of education. I think that's the whole intent behind shows like this, the platform like this is to be that person that's resourceful and that's providing that value add education, because there's so many people out there that are longing and needing this information, and sometimes a lot of people don't even know that they need it. So being able to provide that education is very, very powerful. So we appreciate you adding that value to the community. So,
well, and by the way, thank you for what you're doing. It's like anything, right? You may have heard it before, but you don't remember and memorize everything you've heard unless you're a very special person. So come into, your podcast here. You pick up those little nuggets that remind you about something that you should be doing or looking at within real estate. So it's such a great platform that you're providing. So I really appreciate you having me on today, both you, Cody, and Brian.
Oh, well, we appreciate that, Chris, and we appreciate you sharing your story. I mean, that's the beautiful thing. I've talking to the hundreds and thousands of people that we've talked to over the years. It's everybody's story is different. We're all kind of chasing a similar goal, but everybody's story is different. And it's so unique to hear your journey and the things along your path and kind of your background and things like that. And I think that's what really just kind of opens it up every episode to, like you said, new nuggets, new little tidbits that you can pick up and apply to your business. So it's been fun, man. Really appreciate a great conversation here, but hey, we got a few more questions before you go and then we'll wrap up. Okay.
Sounds good.
All right, Chris. So what do you like to do for your continued education to further your investing?
Well, I definitely digest a lot of podcasts. I walk 2 miles every morning with my dogs. So I always have a podcast on every day, 7 days a week. And then I'm a little bit of Zoom fatigue, but I try to go to some meetups. So I have a monthly meetup, and we had a great person who presented last night, and I learned a ton. And so one of the personal challenges I have for myself is, how do I get really high caliber people that can come into my meetup so I can learn, right? It's just like we're doing today. And then going to conferences. I went to my first conference about a month ago, in 2 years. And oh gosh, I mean, I walked away. It's just like going to a annual sales conference when you're in the sales role. You walk away all pumped up, excited. Your mind has just been going a mile a minute for a whole weekend. And that's how it was with this real estate conference. And so I can't wait to do more of those, because besides the networking piece, it's like a shot in the arm of adrenaline. And at least for me, I really thrive off of that. And I learn a ton.
Well, it's about being present and being surrounded by all those like-minded people that are just always encouraging and keeping you in that positive mindset and that growth mindset. So we definitely agree with you there. So, well, looking back on your journey, Chris, what was that one defining moment of time or event that kind of changed the trajectory of your business?
I think when we started taking, just personally, we started taking that first distribution check, that's when it became real. For, believe it or not, for 15 years, we didn't take any cash out. We just left it in the account. We didn't need it, but let it pile up, and then, put in some more money and then reinvest it into the next deal. And at some point we said, we might slow down in the Portland market. So why don't we start taking a distribution? And we started with a really small one. And like, what are we doing? Why don't we do a bigger distribution? I mean, it's just sitting there making no money as cash. Why don't we individually distribute it? And then we can do with it what we want, reinvest it on our own or whatever. And so that's, to me, a little bit late, but that's when the power of the cash flow and the income stream just really became real. And I've been using that to pay for my kids. So back to the Robert Kiyosaki book, I use that money to pay for the liabilities, right? I use that to pay for my kids' private school. I use it to fund the college account, pay for the car, and I try to use that for the extra stuff that we need to get done with the family.
That's awesome, Chris. And let me tell you that, Brian, that is some crazy discipline. We've heard of guys like sacrifice like 2, 3, maybe 5 years, but 15 years of no distribution, that's some crazy discipline, man. That's kudos to you, man. That's awesome.
Well, think about it. It's compounding on compounding on compounding, right? I mean, you leave it there, you buy something else, it generates more, and then you leave it there, and the generation accelerates, and you just keep rolling it forward. So
it's a long-term game, man. That's good. That's awesome. Well, Chris, what would be some advice you would give to the listeners to help them grow their businesses?
I think we touched on it already, which would be get involved, start talking to people, start networking. It'll accelerate your journey. It'll give you more confidence. It'll give you people that you can rely on when you're not sure. I just recently, right before Thanksgiving, we had an issue. We had a fire. And it was on a property that we were in contract to sell that Monday. Fire happens on a Saturday. We're selling on Monday. I was like, oh, wow, haven't experienced that yet. And so I went to my network of people and I said, hey, anybody out there have any experience with still closing? Because the buyer still wants to buy it and I still want to sell it. Anybody have any experience with selling a deal and moving the liability from the insurance company to the buyer? Things I need to be aware of. And so I put out to my network. Somebody hooked me up with somebody that had just recently done it. They had just bought a property in a similar situation. So if I hadn't had that network, if I hadn't been out connecting with people, I would have figured it out. But if you've ever read that book, Who Not How, why go figure it out yourself if there's somebody out there that's already figured it out and can shorten that curve for you tremendously. And I think that's been powerful for me to learn that.
Yeah, tremendous advice there, Chris. Really, really appreciate that nugget for sure. So, all right, Chris, we'll tell the listeners how they can learn more about you, get connected with you, and learn more about Hightech Freedom Podcast.
Yeah, so if you go to our website, hightechfreedom.com, you can just contact us there. That's a pretty easy way to reach out. Or on LinkedIn, I'm Chris Freeman on LinkedIn. So either one works great.
Awesome. Well, Chris, man, we really appreciate you being on. Again, great conversation. Wish you all the best this year and look forward to staying connected.
Yeah, thanks, Cody. Thanks, Brian.
Thanks, Chris.